Well, Alia and Arun, it's nice to see you both, and I trust you're both keeping well.
Very well, thank you.
Nice. So look,
how about you?
Very good, thanks. Very good, Arun. So look, many folk are talking about Beps 2.0 and the recent release that came out. And one of the topics that a lot of people wonder about is the question of tax incentives and what will Beps 2.0 mean for tax incentives going forward. So maybe, Alia, I could maybe ask you, how prevalent are tax incentives across the Asia-Pacific region?
Thanks, Rodney. Yeah, they're very prevalent across the region. We did a survey around the region, and there were over 40 different types of tax incentives. And once you factor in variants of those, that can stretch into the hundreds. There are at least 13 jurisdictions that offer tax holidays for a fixed number of years. And then there were 8 with tax-free or low tax status for those that set up in special economic zones. There were at least 6 that had activity-based or industry-based incentives, so things like regional headquarters or treasury centres, and also things like global trading centres. A good number of them had a range of R&D type incentives, so that might be sort of refundable or non-refundable credits. A number of them also had things like enhanced deductions as well. And of course, countries like Singapore, Malaysia and Hong Kong also give tax exemptions for things like foreign sourced income and capital gains.
So really, when you look at the landscape across Asia Pacific, then a lot of countries are using tax incentives and a wide variety of tax incentives too, by the sounds.
Exactly right.
So Arun, thinking about India for a minute then, tell us about some of the tax incentives most commonly employed by multinationals in India.
Yeah, so certainly in India, India's used tax incentives as a part of its tax policy to incentivize, primarily driven towards exports because, India's always, wanted to encourage exports as a developing country. So traditionally we've targeted exports. Then IT being a big sector in India and services being a big sector, many of our tax holidays were targeted towards, IT services or services sector operating out of either special economic zones or, there were certain tax holidays. We still have only a handful of them because I think as a policy, there's been a shift. We're moving away from income-based tax incentives to more, capex deduction-based incentives. So while we still have them, but like I said, the general shift is moving away from tax incentives. Having said that, like I said, there are a couple of them, a handful of them. But what's important is we also have an alternate minimum tax or a minimum alternate tax that are even to tax most of the tax incentive units as well. So purely from a Beps 2 perspective, India may not be that impacted when you take the overall ETR calculation if you factor in MAT or alternate minimum tax.
Interesting, and that's because India as an industrial policy has moved away from tax incentives and focuses on other business incentives instead. Well, so Alia, how do you think countries in the region will react? And it's crystal ball gazing, but how do you think countries will react to the Beps 2.0 measures?
Yeah, I mean, I guess one of the key things to note here is that unlike some of the other Beps measures, Pillar 2 can still indirectly impact a jurisdiction, even if it doesn't elect to sign up to the measures. Say if you had an entity in Singapore that claims a tax incentive, which means its effective tax rate is less than 15%, then top-up tax can be applied at the parent level. So there's no real benefit in this case for Singapore continuing to offer that low tax incentive if another country is just going to effectively take the revenue. So I think we're going to see, because of that, I think we're going to see a repeal or increasing rates for some of these more generous tax incentives. There might be a bit with the benefits of jurisdictional blending. You might get ones that are say 10% and over surviving, but maybe ones under that rate, don't survive. Another thing, and another thing that some of the hub locations are looking at is as Arun mentioned, this alternative minimum tax concept. So some are looking about it in terms of just what's for companies that are in the scope of Pillar 2 and but continuing to apply their tax incentives for ones that are outside the scope of Pillar 2. So I think that's going to be an interesting one, because that would allow countries to still keep their tax incentives for some of the smaller groups, but making sure that they get to collect the top-up tax domestically rather than another jurisdiction taking it.
Interesting, almost like
yeah.
a two-track or a two-speed tax system. Almost.
Yeah, exactly. Could make it quite complicated quite quickly. I think we're also going to see a bit of more of a proliferation of things like grants and other non-tax incentives to try and encourage business to countries. But it remains to be seen how the OECD deals with, in particular, grants that look a lot like tax incentives. And then interestingly, we heard the other day that there was a client that was approached by one of the Southeast Asian country tax authorities. They had a long-dated tax holiday approved in that country, and they were asked by the tax authorities to just stop claiming that from 2023 onwards, even though they still had the right to. So that was an interesting development.
Well, it's an option. So, Arun, how do you think India will react?
So, Ronnie, like I said, it ties in perfectly well with what India has already been doing. So we're moving away from tax incentives as a policy measure. But what's also started to happen is, for instance, last couple of years, there's been a big thrust on manufacturing. So a couple of things that India has done is there are special regimes, which a manufacturing setup could opt for. A new entity setting up manufacturing operations could opt for that regime. So there is a reduced tax rate, but that's still about 15%, 17%, but you don't claim any tax incentives. And that option is also available to a normal corporate, any company to opt for a concessional regime, but you have to give up all tax incentives. And the rates there are way above. So we have 25% ETR and 17% ETR. So I don't see a huge impact in terms of offering other incentives. In the manufacturing side, we are already seeing that India has come up with a production-linked incentive scheme. That's not a income-based tax. It's like a cashback given on ramping up your production facilities, but that operates outside the income tax or corporate taxes. So those kind of things will continue to, that will be a part of a policy. That's the way I see it going.
So interesting. And Alia, it almost sounds like what you were saying is you could imagine that countries in Asia Pacific might start to look at that as maybe some form of template as a replacement for some of these other systems they have in place at the moment. Now, so Alia, I'll stick with you for a minute. We had discussed earlier on how the top-up tax might apply at the parent company level for incentivized companies. What other issues do clients need to think about when it comes to the subject to tax rule?
Yeah, so depending on the eventual design, the subject to tax rule is one that's really important to watch for this region, because as it's currently designed, it takes priority to the income inclusion rule and under-tax payment rule, and it applies on a payment basis rather than an overall effective tax rate basis. So, for instance, in Singapore, incentives tend to apply to buckets of income. So you might have one concessionally taxed bucket and then a regular tax rate bucket as well. And so when you blend them all together, you might have an ETR of over 15%. But because the subject to tax rule applies on a per payment basis, you could still get caught. So it looks at how those intergroup payments are individually taxed. So you might have an interest or royalty payment or some sort of high value service payment that's being taxed at a 5% rate. And so then the country making that payment might have the right to apply top-up tax by way of a withholding. So I think this is going to be an interesting one. It is treaty-based, so it won't apply to all covered payments, but the IS statement in July did indicate that developing countries will be able to effectively force other countries to amend their bilateral treaties to facilitate this rule. So it's going to be an interesting one to watch. It's one for not just for subsidiaries and branches to think about. It's not just a head company problem. And really, there's going to be a lot of challenges making that operational.
And Arun, just listening to that, I wonder if you have any views on how these changes might cause groups to reconsider the way they're currently structured.
And Rodney, very interestingly, these are the conversations we are having, or at least trying to have with some of the India headquarter companies, because I think that's where we see the impact. right now, it's more creating awareness. What we're telling them is that, look, you need to look at your structure and identify your need to be in a country just for the purposes of tax holiday. If that's the only entity you have, you're claiming they're just for tax holiday, and it's the ETR is below 15%, you're not going to get anything going forward. India would collect that tax, or you could have STTR, and a host of things could happen. So maybe take advantage of jurisdictional blending. I mean, that's the way you want to structure. You be in a country not only for tax holiday, but you can centralize your operations, be in a jurisdiction if that's important enough for you to be, and blend your operations so that you take advantage of the blending, your ETR moves above whatever threshold is decided, then you're fine. So those are the conversations we're having. On the other thing is, if you are in a regional headquarters setup, or you're taking that exemption, and if that goes away, and looking at the current setup of pandemic, do you want to, where you're working from home, do you really need a regional headquarters? And can you restructure yourself in a different way so that you are not hit by this withdrawal of exemption? So, like I said, these are early days. Plans are also waiting and watching, but those are the sort of thoughts we are leaving with them.
And very interesting, Arun, because I can imagine those sorts of discussions. Ultimately, it's a game of numbers, right? So that must mean that people need to be thinking about modeling out these scenarios and what they might truly mean for their organization, if anything.
Yeah. And Rodney, interestingly, that's another aspect. The data that the data mining that needs to be done, or modeling that needs to be done, your systems need to be geared up for that. It's early days for those conversations, and it's hard selling them to tax heads who see it as a distant thing. But that's also, we try and sneak that in our conversations as well.
Interesting. Well, look, so Alia, just the final word on this. What other things should clients be thinking about when it comes to Pillar 2 and tax incentives?
Yeah, I mean, I think it's monitoring what's going on as the starting point. So, I mean, the July inclusive framework statement heading towards possible further carve-outs of substance-based incentives, and that was sort of following on from some of the intense lobbying going on, particularly for manufacturers. But it remains to be seen what's going to be in the eventual agreement. I think also clients should be looking to engage with their local policymakers on how they're going to deal with their reactions to some of this and their local tax incentives in a Pillar 2 world. And Arun mentioned earlier, sort of data and the importance of get a whole new bunch of information that you never had to get before, or slice it, dice it different ways. And also you alluded to earlier, I think, which is a really important one, about modelling. So modelling the impact of some of these changes to understand how can the value of your tax incentives going forward, how you might want to respond to that and maybe restructure your operations. So I think that's a particularly important one, even before we have the final rules, because it's now getting on the radar of boards, and they expect the tax teams to be across what the potential impact of these measures is. And I know Rodney, you and the rest of the global team have a number of really good little modelling tools to be able to help with that.
Well, it's interesting, right? Because 2023 sounds like a long way away, but it's not really, particularly if you need to figure out how to get data out of your ERPs. So Arun, Alia, fascinating. We're just definitely going to have to watch the space, just given, on the one hand, the almost reliance Asia Pacific has in using selected but multiple types of tax incentives to drive industrial policy. And on the other hand, Arun, what's going on in India, slightly different, has already moved to business-based grants and incentives, and just how both of those worlds play out as Beps 2.0 proceeds. So thank you very much both for your time. Please have a good morning, and I look forward to seeing you again in person when in fact we can travel again.